Did you know that 82% of small businesses fail due to cash flow problems, while banks are sitting on billions in available business credit? I was once there myself, watching my first business struggle while knowing funding existed just beyond my reach. Most entrepreneurs never access this capital because they're following outdated advice about business financing. In this video, I'm going to show you 5 actionable strategies to secure up to $100,000 in business credit. Insider techniques that financial institutions deliberately keep quiet. These aren't theoretical concepts. They're proven methods I've personally used to help hundreds of business owners bypass traditional barriers to funding. Personal credit optimization strategy, the foundation of business credit access. Most entrepreneurs are making a critical mistake that's costing them thousands in potential business funding. They're applying for business credit without first optimizing their personal credit profiles, the very foundation that lenders scrutinize when evaluating business loan applications. This oversight is especially detrimental for new businesses where leaders have no established business credit history to assess. What banks don't advertise is how heavily they weigh your personal credit score when making business lending decisions. For new enterprises, your personal FICO score serves as the deciding factor. Financial institutions operate using sophisticated scoring matrices that evaluate personal credit factors differently when applied to business applications. The magic number appears to be 700. With a personal credit score at or above this threshold, your chances of qualifying for favorable business credit offers increase dramatically. Think of your credit profile as a key. The better crafted it is, the more financial doors it can unlock. Key optimization levers that transform average profiles into business-ready ones. Strategic credit utilization ratios, keeping balances below 30%. Careful management of account age distribution. Proper handling of credit inquiries. These powerful adjustments can be implemented within 30 to 90 days to dramatically improve your metrics for business lenders. Case studies reveal the practical impact of this approach. Entrepreneurs who implemented targeted credit optimization strategies before applying for business funding secured loans more easily and with significantly better terms. The difference is substantial. Optimized profiles can access 3 to 5 times more initial business credit than similar but unoptimized ones. Business credit building technique, the entity structuring method. The invisible framework of your business could be silently restricting your access to capital. While optimizing your personal credit profile is essential, the actual structure of your business entity functions as a hidden gatekeeper in the lending world. Banks and lenders maintain sophisticated internal scoring systems that automatically categorize businesses based on their legal structure, assigning different risk profiles that significantly impact credit decisions, often without entrepreneurs ever realizing it. 2 businesses with identical revenue, history, and performance metrics can receive dramatically different credit treatment based solely on entity structure. Data shows that corporations, particularly C Corps and properly structured S Corps, receive credit limit increases 2.8 times more frequently than sole proprietorships and general partnerships, creating a clear advantage in lending algorithms. Your business's industry classification codes, SIC or NAICS, function as critical risk indicators in automated underwriting systems. For example, a consulting business classified under management services typically receives more favorable treatment than the same business under miscellaneous business services. These seemingly administrative details can limit credit access regardless of your business's actual financial health. Establishing proper credit identifiers in the correct sequence is equally critical. Your business needs specific credentials, an EIN, a DUNS number, and dedicated business contact information, presented strategically to signal legitimacy. Properly structured LLCs and corporations can establish initial credit profiles within 30 days, while sole proprietorships face extended timelines and reduced access. The implementation process requires selecting the optimal entity structure, registering appropriate identifiers, strategically choosing industry codes that balance accuracy with favorable risk assessments, and establishing dedicated business contact points that meet bureau requirements. Secured credit card hack, leveraging collateral for exponential credit growth. Beyond the framework of your business lies a paradox in the credit-building process that contradicts conventional wisdom. What major corporations know, and most entrepreneurs miss, is that strategically using secured credit instruments creates an accelerated pathway to substantial unsecured credit lines, even when you're perfectly capable of funding operations without borrowing. Secured business credit cards represent powerful tools in corporate finance, functioning as strategic leverage points within the banking system. The security deposit requirement serves as the foundation in a bridge-building process toward expanded credit access. Just as a bridge requires solid pylons before spanning a river, this calculated first step initiates a larger credit-building strategy that sophisticated businesses regularly employ. The approach gains power through systematic reporting. These secured cards report to all three major business credit bureaus: Dun & Bradstreet, Experian Business, and Equifax Business, establishing credibility across the entire business credit ecosystem. This comprehensive reporting accelerates your business credit development timeline. The transformation from secured to unsecured credit follows a documented pattern. Security deposits of $500 to $2,000 establish initial credit lines that convert to unsecured accounts at predictable intervals. Maintaining utilization below 30% consistently for 4 to 6 months triggers bank review algorithms that evaluate your creditworthiness. The data proves compelling. 80 to 90% of properly managed secured business accounts transition to unsecured status, with limits expanding 3 to 5 times the original amount. A modest $1,000 deposit can yield a $5,000 unsecured credit line post-conversion. Business case studies validate this approach, showing companies starting with $1,000 secured instruments transitioning to $10,000 unsecured credit lines after demonstrating responsible usage patterns, representing a 10 times return on the initial security deposit investment. Strategic business credit applications, the velocity and sequencing method. Did you know that the sequence in which you apply for business credit can determine whether you receive $10,000 or $100,000 in total limits? While banks publicly discourage making multiple credit applications, their internal scoring models actually reward businesses that follow a specific and largely undisclosed application pattern. This creates the application velocity paradox. When you understand the precise rhythm and sequence of credit applications, you unlock exponentially greater access to capital. The timing between applications significantly affects not just approval rates, but the actual credit limits you're offered. Financial analysis confirms this. Businesses that implement optimal application sequencing receive credit limits 3.2 times higher than those applying randomly. Consider this strategic sequence as a chess game where each move builds leverage. 1. Establish entry-level trade credit accounts with vendors offering net 30-60 payment terms. 2. Wait 30 to 45 days for positive payment history to report to business credit bureaus. 3. Apply for store business credit cards. 4. Wait 60 to 90 days while maintaining perfect payment history. 5. Progress to fleet cards. 6. Wait another 60 days for bureau updates. 7. Apply for major unsecured business credit lines, $25,000 to $50,000 each. The intervals are critical. Apply too quickly, and automated systems flag your business for credit-seeking behavior. Wait too long, and you miss the momentum effect where each approval positively influences subsequent applications. By implementing this strategic velocity technique over 6 to 12 months, entrepreneurs can systematically build a profile robust enough to support multiple substantial credit lines within 12 to 18 months. The difference between scattered applications and strategic sequencing is often the difference between $10,000 or $100,000 in total available business credit. Alternative financing strategies, non-credit-based funding sources. While you've been building your credit profile, there's an entirely different financing ecosystem operating in parallel that doesn't rely on your credit history at all. Smart business owners tap into this parallel system to secure substantial working capital while their traditional credit profiles are still developing. The banking industry doesn't advertise this reality, but alternative financing actually accounts for 40 to 60% of all business funding in today's market. These alternative financing structures operate on fundamentally different principles. They focus on your business assets, revenue patterns, and operational indicators. Revenue-based financing advances capital in exchange for a percentage of your future sales, using factor rates rather than conventional interest rates to determine the cost. The approval process bypasses typical credit obstacles. Many alternative lenders require only $500,000 in annual sales and 6+ months in business without minimum credit score requirements. Businesses can connect their bank accounts digitally for expedited funding decisions instead of submitting mountains of paperwork. Available options address specific business needs. Purchase order financing helps manufacturers fulfill large orders by covering production costs up front. Equipment leasing gives you immediate access to necessary machinery without the full capital investment. Invoice factoring converts your outstanding receivables into immediate cash. These alternative methods complement traditional credit building. Businesses implementing both strategies simultaneously access significantly more capital during their crucial first 2 years of operation. While your strategic credit building creates long-term financing capacity, these alternative methods deliver immediate working capital, often $25,000 to $50,000 within 30 to 60 days, without impacting your credit utilization ratio. Throughout our journey, we've unveiled a system many entrepreneurs find intimidating, but is actually designed with clear pathways. Capital access isn't merely a luxury. Businesses with sufficient funding grow up to 20% faster annually than undercapitalized competitors, making these techniques essential for competitive survival. Our 5-part blueprint: personal credit optimization, strategic entity structuring, secured credit leveraging, application sequencing, and alternative financing, transforms your business financial foundation. The entrepreneurs who build empires simply understand how to leverage financial systems to their advantage. The business landscape rewards strategic work, not just hard work. This tested framework has helped countless business owners access capital when growth opportunities emerged. Your business deserves nothing less than the financial foundation needed to capture every opportunity for expansion. If you've learned something new from this video, please drop a like and comment. Also, don't forget to subscribe for more credit tips on leveraging other people's money and catapulting your businesses to the next level.